What would you say if I told you there was a safe and easy stock you could buy and double your money? Well, you'd probably say one of two things. First, you'd tell me I'm crazy, or second, you'd say sign me up. That was exactly what I was thinking when I looked at an article the other day. And this article came out a couple of weeks ago and it talks about one of my favorite Canadian companies. It's a company called Pembina Pipelines. Really simple idea. It's a nice, solid midstream company. They've been growing through acquisitions. They pay a nice, solid dividend. It's a safe, kind of sleepy play. So when I saw a headline saying that it was 49% undervalued, I just knew I needed to make a video to talk about not only the company and what this headline is saying, but also the way we look at valuations and the kind of decisions we as retail investors should be making based on them. Welcome to Golden Lurch Investing. My name is Liam, and on this channel, we love to talk about investing in Canada. If that interests you, please do subscribe to the channel, like the video, means a huge amount and doesn't cost anything. So let's start off by reminding ourselves, what the heck is Pembina Pipelines again? Like I mentioned, nice, solid midstream company, really focuses on bringing oil and natural gas and transporting them from producers up in Alberta and northeastern BC and down to the sort of downstream players. And they're one of the big players in that space. They might not be quite the size of an Enbridge or even a TC, but they are a big player. They also have been a great dividend growth opportunity. They've made some really interesting acquisitions. They've been sort of playing in the space. They've been really focused on paying down debt. I've loved their management team. So it's a stock that I've spoken very positively about here on the channel. And I've done a video that I will link down below talking just about their story. It was one of the first videos that I really enjoyed making because it was just such an interesting story, the way they had grown from this one small pipeline into this giant midstream company. However, midstream companies are not usually the kind of firms you'd expect to be at a 49% discount. And so I'm going to show you guys an article from Simply Wall Street that talks about this. And I think there's some really interesting things that both this article tell us and that we can sort of read between the lines when we're talking about Canadian companies. So let's jump over. I'll toss it up on the screen. Got it right here beside me. And again, the headline is asking if there is an opportunity with Pembina Pipelines 49% undervaluation. So clearly they're pretty set on this undervaluation, and their question is actually, is it an opportunity? And so let's scroll down and see why they say this. Well, they're saying the projected fair value for Pembina Pipelines is 103 Canadian dollars based on two-stage free cash flow to equity. And that is about 49% undervalued based on the current share price. This was released Christmas Eve of 2024. So a couple of weeks old, but still $103 is an amazing return for a company like this. They also do point out, however, that their fair value estimate is dramatically higher than Pembina Pipeline's analyst price target of $61. So what gives? I think that's the first big warning sign here. So in this article, they're talking about something called their DCF model, the discounted cash flow model, and that they're just going to walk through this one valuation. They warn us there's all sorts of other ways. They're using a two-stage DCF model, which takes into account two stages of growth. First is the higher growth stage, which levels off heading towards terminal value, captured in the steady growth period. So they need to get an estimate of the next 10 years of cash flows. Where possible, they use analyst estimates, but when those aren't available, they extrapolate from the latest estimate or reported value, assume companies are shrinking free cash flow, slow the rate of shrinkage. Anyways, this is what they forecast, okay? So levered free cash flow 2025, 2 billion, 26, 2.3, 27, 2.58, 28, 2.9, 2029, we're seeing 3.18, 2030, 3.4, and so on and so on. Until 2034, they're expecting $4.1 billion free cash flows. And the growth rate estimate source, taking analyst times 5, analyst times 3, analyst times 3, analyst times 2, and they end up at their present value discounted, and they cut it down. And so they end up with a present value of 10-year free cash flow of $21 billion. Divide that up, and you end up with their fair value share price, which they show just down here at the bottom here, current price over the fair value. And they're saying that's where it's about right. That's where the pricing they think is fair. Now, there's one important thing I want to point out on here. The first thing, all of this math is entirely dependent on analyst free cash flow predictions. And as every investor knows, analyst predictions are only ever as good as the company's own forecasts, as the analyst's ability to predict market trends, to predict geopolitical events, and as the analyst's ability to guesstimate what the sort of free cash flows are going to look like for the next year. So predicting based on free cash flow might be crazy. And we're also talking about a two-stage growth model here. So these folks at Simply Wall Street are predicting that there's going to be a fast growth stage. I would maybe question that, considering everything we know that's going to happen. This is a Canadian oil and gas company, and we're talking 2025. In 5 days, we could have no idea what is happening to this company. So maybe a little bit brave to assume that we're going to beat expectations that great, that we're going to be growing quite fast. But I would say maybe 26, we could see some really fast growth. It depends. It depends on the price of Canadian oil. It depends on the price of oil in general. It depends on geopolitical events. So much going into that. They do talk about some important assumptions, right? They recommend that people go and calculate this themselves. Their math is correct, I will say, based on everything, all the assumptions they're making. The math they've done is correct. I think it's really just the assumptions that's a question. They talk about all sorts of different things in here. Talked about a levered beta. Anyways, doesn't really matter. My big point here is that this headline might be showing us a 49% undervaluation based on the math they've done. Their math might be correct. They might have done everything right. It's probably going to be wrong. I can almost guarantee you, I can't fully, but almost guarantee you this stock isn't going to sit at 102.7 Canadian dollars at any point this year. Might go higher, might go lower, probably lower, but it's definitely not going to sit at that value. We're not going to see this thing double because regardless of how correct the math might be, the market wouldn't let that much alpha sit on the table. They wouldn't let that opportunity, if there really was an opportunity to buy a safe, steady, fully grown, mature company and double your money, that opportunity wouldn't just be sitting here waiting for us on the internet to find an article. There are too many incredibly skilled investors out there that know something that we as investors don't. One of the things I really do appreciate, though, is they have a SWOT analysis. This is strength, weakness, opportunity, threat. And I think when we talk about opportunities and we talk about threats, some interesting stuff, but I really want to focus on weakness. So anyways, I'll zoom through the strengths here. So earnings growth over the past year exceeded the industry. Yeah, I love this management team. I'm not going to lie to you guys. I think they've done a really good job. Well-covered debt, well-covered dividends. So you're not worried about dividends eating into free cash flow. You're not worried about debt drowning this company. We're not, hopefully, fingers crossed, not going to see a BCE out of this one. I think it would take an insane level of bad decision making for this great management team to end up in that position that BCE is in right now. But their strengths are doing pretty well. Weaknesses, they're saying dividends a little bit lower. These guys are a dividend growth company. I'm okay with that. They've diluted shareholders, sure. I think that's interesting. So I don't know if the dividend being a little low compared to the top 25% of dividend payers is that big a challenge, in my opinion. This company has been growing. They've been growing their dividend, and they're going to continue to look for opportunities. A lot of the companies that are paying out the top 25% in dividends aren't in that same position. Those companies are fully mature. They're not looking for growth. They're simply looking to satisfy shareholders. So I wouldn't be too mad about that. Dilution. Okay, normally as a shareholder, I don't love dilution, but I do understand it if you're making big acquisitions, right? I mean, it's kind of a key part of any massive acquisition package, is that you're going to have to dilute. My hope is just that management, who in this case are going to focus on returning that value to shareholders after they've, acquired this asset or company or whatever it might be that they've diluted to acquire, and they've sort of got the integration and the efficiencies they need. Pembina's done a really good job of that. Think about the Varen acquisition, right? Like huge money involved, lots of moving pieces and things going on. It looks like they've done a really good job navigating. And they've talked about how now, okay, hey, we took on this risk, we took on this debt, took on this dilution, and now we're turning back towards providing value to shareholders. Opportunity. So we're looking at earnings growth. Okay. I don't know if I call it an opportunity. I mean, I'm happy to see that. And we're seeing that it's well below Simply Wall Street's fair value. Sure. My opportunity, when I talked about this company earlier, I think that there's some asset opportunities here. There's going to be some discounting, and there's obviously some expansion opportunities now that we're talking about. We might be back to a period of investment in oil. Now, threat. Annual earnings are forecast to grow slower than the market. Sure. I think the number one threat would be geopolitical risk. I think, I would like spray paint over this list. Geopolitical risk, particularly tariffs, sure, but just in general are a huge threat to this company. What if they're looking at a 25% tariff next week? What if we're looking at, an end to all of the various global conflicts and oil prices dropping? What if we're looking at OPEC going back on their current plans to keep the oil price up, and we see the oil price crash down to 60 or lower a barrel? Right? That's the real threat, in my opinion, for a company like this, particularly if they are, trying to navigate through acquisitions and they're a little bit debt laden, right? If you're all of a sudden losing big money, these free cash flows just aren't going to be in the same kind of position they are, and the current valuation might be cut. So they make some recommendations, but I'm going to just sort of bring it back to the camera here, and I'm going to make my own. I think that articles like this are fun to read. It's interesting to learn about the different valuation models, and it's valuable to look at the different ways you can project future growth and project what a fair value for a business might be. But I don't think that you and I, retail investors, should be making investment decisions with the expectation that the market will follow the math and do what simple math explains should happen, because the market is irrational. If there was $50 a share of alpha sitting out there that could just be exploited, I'm mostly, almost 100% confident it would be by now. It's very, very far and few between where we see the markets really miss out on huge opportunities like that. And retail investors catch them. There's only a very small list of examples I could think of. And while Pembina is one of these amazing companies that I am personally invested in, and that I will continue to invest in, I'm not investing with the expectation of short-term massive gains, because all that will do is set me up to be incredibly disappointed. So instead, I'm investing for a growing dividend. I'm investing for a strong management team. I'm investing because it's a business section, the Canadian midstream market, that I think is going to see more investment, that I think needs to see more investment. And I think these companies will become more powerful and larger in the not so distant future. I think they are incredibly valuable to our country. I think we are seeing that more and more as 2025 comes along than we have for many, many years, if not a decade plus. And I think Pembina is well positioned to continue to grow, make smart investments. And again, I love the way their management team has been handling the different things thrown at them. So is Pembina Pipelines 49% undervalued? Can you double your money easily? I don't think so. Does that mean you shouldn't invest? Absolutely not. You should be investing in this company. It is a great opportunity, in my opinion, for most people that have the same kind of interest as I do, who are looking for dividends, who are looking to buy Canadian, who are looking to be in these markets. Pembina is a great spot. It's on my portfolio, publicly available on Blossom and that I talk about every month in my large fund episodes. So my opinion is pretty clear here. But let me know what you guys think. Do you think I'm missing something? Do you actually think this company is going to double in the not so distant future? And what do you think about these kinds of valuation models? Should we talk about them more in these videos, or do you think that sometimes, as tempting as it is to just do the math and assume the markets will follow, that in reality, the markets are just a little too messy to follow what looks like it must be such a great opportunity? Let me know in the comments down below. Again, if this is something that interests you, we talk about investing in Canada every week on this channel. So please do subscribe to the channel, like the video, and I'll see you in the next one.